Donald Trump just deployed 15,000 American service members, over 100 aircraft, and guided missile destroyers into the world's most dangerous waterway. It was the most significant unilateral military operation since the war began. It was announced with a name, or Project Freedom, and a warning that any interference would be dealt with forcefully. It was backed by the full might of U.S. Central Command, and the oil market looked at all of it and did absolutely nothing. Brent crude this morning, essentially flat, WTI slightly lower. Not the relief rally that Trump's transport secretary promised. Not the price collapse that a reopened Strait of Hormuz would theoretically trigger. Just flat, unmoved, unconvinced. And here's the question that every energy analyst, every central banker, and every government watching this conflict from the outside is now asking: if 15,000 troops, 100 aircraft, and the most powerful navy in the world cannot calm the oil market, what exactly will? Stay with me. Because the answer to that question is more complicated and more alarming than anyone in the Trump administration wants to admit. Let's go back to before the war, because those numbers are what this story is really about. On February 27th, 2026, the day before the U.S. and Israel launched their strikes on Iran, Brent crude was trading at just over $70 a barrel. That was the baseline, the pre-war price. The price the global economy had adjusted to, built supply chains around, and budgeted for. The next day, the war began. The Strait of Hormuz closed, and oil prices began their climb. They did not stop. Brent hit $90, then $100, then higher. This morning, it is trading at approximately $108. That is a rise of more than 50% in 65 days, and that 50% premium has not gone away. Not through the ceasefire announced on April 8th, not through Iran's brief announcement that the strait was open in mid-April, not through OPEC Plus production increases, and not through Project Freedom. Goldman Sachs put out an estimate this week that should be read and reread by everyone commenting on this conflict. The closure of the Strait of Hormuz and attacks on energy infrastructure have reduced global daily oil production by 14.5 million barrels. Every single day. 14.5 million barrels that the world was counting on, that refineries were contracted for, that shipping schedules were built around, that economies from Tokyo to Mumbai to Stuttgart were running on, gone, daily. Project Freedom is a mission to guide stranded civilian ships out of the strait. It is not a mission to reopen the strait to full commercial traffic. It is not a mission to remove Iranian mines. It is not a deal that ends the blockade. And the oil market, in Ascend, which trades on reality, not announcements, priced exactly that in this morning. Here is the specific problem that the oil market is processing this morning, and why traders are not buying what Trump is selling. Project Freedom, as described by CENTCOM and two U.S. officials cited by Axios, is not a full navigation reopening of the Strait of Hormuz. U.S. Navy ships will be in the vicinity, rather than physically escorting convoys. The operation is providing commercial vessels with information on safe maritime lanes, specifically those not mined by Iranian forces. It is in Jennifer Parker's description from the Lowy Institute, an operation aimed at making ships feel safe, rather than guaranteeing their physical protection. And feeling safe and being safe are different things. Iran has said any U.S. interference in the Strait's new maritime regime constitutes a ceasefire violation. The IRGC has patrol boats in the water. A cargo ship was attacked by multiple small craft this morning, the first such incident since April 22nd. And Iran has not announced the removal of, or even acknowledged the location of all the mines it placed in the strait. Mines that Iranian commanders themselves have lost track of. One analyst from Al Jazeera's energy desk put it plainly: normalizing the flow through the Strait of Hormuz will take more than what Project Freedom is offering, whilst the yawning gap in oil supply will take months to resolve. That is not a fringe view. That is the consensus view among energy economists this morning, and the oil price is reflecting it in real time. This could trigger a deeper market realization that the energy disruption caused by this war is structural, not situational. Experts warn that even if a peace deal is signed tomorrow, even if the strait is formally declared open this week, the physical supply gap Goldman Sachs has estimated at 14.5 million barrels per day cannot be filled overnight. Infrastructure is damaged. Shadow fleet tankers are under blockade or seizure. Iranian production has been deliberately curtailed to manage storage. Saudi, Iraqi, and Kuwaiti exports are constrained by the same blockade that has trapped their tankers. The supply is not just missing, it may be missing for months. Development 1. CNBC called it Trump's Hormuz Gambit lands with a whimper. And the market data backs up every word. CNBC's morning brief this morning was headlined, without ambiguity, Trump's Hormuz Gambit lands with a whimper. The numbers behind that headline: Brent crude at approximately $108, down a fraction of a percent. WTI at around 101, marginally lower. S&P 500 futures slightly higher, the bond market unmoved, gold slightly lower, the dollar flat. Fortune reported that financial markets were muted on Sunday as investors were reluctant to bite on the latest well-timed social media post from President Donald Trump about Iran. That phrase, well-timed social media post, is a market verdict. It is traders saying, we have seen this before. Technical analysts at Invez noted this morning that WTI is forming a diamond reversal pattern on the daily chart, a common bearish reversal signal, predicting a slide toward $95 if diplomatic progress continues. Development 2. OPEC Plus voted to increase production, and it almost doesn't matter. 7 OPEC Plus members agreed to raise production targets by 188,000 barrels per day in June. The problem? Saudi Arabia, Iraq, and Kuwait have tankers trapped in the Persian Gulf that cannot export through the Strait of Hormuz. Voting to increase production when exports are blocked changes nothing in the short term. Development 3. Producers are shutting down, not because demand fell, but because they cannot ship oil. Stephen Innes described a situation where hundreds of tankers are stranded, storage is full, and producers are forced to shut production. The supply chain is broken at the exit point, not the source. Development 4. Prices will remain elevated even after peace. The backlog of tankers, damaged infrastructure, and disrupted logistics means recovery will take months. Even if the strait opens tomorrow, oil will not immediately return to pre-war levels. A 50% rise in oil prices affects every country. Nations like Japan, India, and Pakistan rely heavily on Gulf oil and are paying war premiums. In the U.S., gas prices are at $4.45 per gallon, directly impacting voters. The UAE leaving OPEC Plus signals deeper structural changes in global energy politics. The market is flat, but at $108, not $70. The market expects slow progress. But 2 scenarios could change everything: a military escalation, pushing oil above $120, or a diplomatic breakthrough, causing a sharp drop. Right now, the market cannot decide which is more likely. It is not calm. It is waiting. Project Freedom has begun. 15,000 troops, aircraft, and naval forces are deployed. Iran has called it a violation. The oil market has not reacted. 14.5 million barrels per day remain missing. Hundreds of tankers remain stuck. OPEC Plus increases are insignificant compared to losses. Project Freedom may help ships, but it does not restore supply. Only a full deal can do that. That deal does not exist yet. The market has already given its verdict. It's not enough. And the world is watching what happens next.